We want to welcome everyone to the Zacks Quarterly Market Strategy Conference Call. This is a service of Zacks Professional Services Division, and for any first-time attendees, this live conference call features Zacks strategists providing their analysis of the latest issues and trends affecting investors, the market, and the economy both globally and here in the U.S. Chief Equity Strategist and Economist for Zacks, John Blank, and Research Director Shiraz Mian are our panelists today. John, we're going to start with you. Let's get right to it. You're focusing on the Alibaba story, and if I'm understanding it correctly, how it actually touches all of the current global hot-button issues, right?
That's it, Terry. Thanks for the introduction. I want to give a little background on how I fell into Alibaba as a subject, because I am a macroeconomist and a chief equity strategist, and typically I do a call for all of you about top-down things. So I've learned doing CNBC Asia work over the last 4 months. I've been asked twice to look into BABA because of the interest in BABA. It's the second largest security trade in all of China, and it's an enormous company. So what I've learned, though, is that there's this idea of reading Jack Ma, the CEO, and his team, and things like the South China Morning Post and various other places, and you'll always hear them talk like macroeconomists about China, very informed, thinking about China. And so there's a very good reason for this, and this is a very great insight for all of you, is that BABA is now so big, it has 700 million consumers out of a possible 800 million mobile subscribers in China, that it effectively becomes what's called a national champion. A national champion is sort of like a monopoly or an oligopoly. You can have several national champions in the industry or one. And China isn't the first place in the world to try national champions. I mean, Pemex and Cemex in Mexico, Braskem and Petrobras in Brazil, many of the ETFs that are non-U.S. will include tons of state-owned enterprises that list their shares and publicly trade them. BABA is no different, other than it's in the tech space in China. And so over the last 15 years, China has basically decided they need to do national champion stuff with their tech industry. And when Jack Ma comes along with a good idea, they basically anoint it with this national champion status. Now, they're not going to go out and tell you this in the news. So how do you know what a national champion is? Well, I'll tell you why. If you didn't know this about BABA, you can't vote. You don't get voting rights with BABA shares. They are actually, it's a Cayman Islands. It's called Alibaba Holdings Incorporated in Cayman Islands is where your shares are located, and then they back shares in China. But you don't actually get voting rights. And for example, Huawei, who you've heard in the news on the trade war with the CFO being locked away, she's the daughter of the founder of Huawei. What you'll find out is Huawei was into phone switching in the 80s, and I'm talking old school phone switching, like the lady in the grocery store, you know, switching phones with cables, basically kind of a Cisco play, all the way to being the largest cell phone provider in China, and it wasn't even in cell phones until 2014, really. So a lot of the weakness you're hearing about Apple in China is because Huawei was anointed as the national champion of the mobile experience in China, and they've gone from 40 billion in revenue to 160 or 180 billion over 5 years. So what you're going to see with national champions is this very trajectory. They dominate spaces, they grow to incredible sizes, and it's almost like they're magic. And the point is, they're not magic. The government is anointing these companies. It's called national champions, and no, it's not a Chinese idea. Now, so what I've learned with BABA is that I've got these 5 points for you, and I'll try to go through most of them. I've got 30-some slides. I'm not going to get through all of them, but I want to give you the idea that you come back later to these slides and learn for yourself just what a rich trove of insight BABA has as a macro story, as a China story. Because we know for a fact all the GDP stuff in China is worthless. But it's worthless for bearish talking or bullish talking. It's inscrutable. It's not anything anybody can use. So, I mean, obviously people say, oh, the debt problem, all these problems. We cannot use the macroeconomic statistics for either bear or bullish. It's just inscrutable. But again, BABA lists internationally, trades internationally, and it must conform to Sarbanes-Oxley standards for its accounting. So unless you think Baba's breaking the law under Sarbanes-Oxley, you can trust Baba's accounting. And Baba, like Huawei, are these national champions, and they have basically acquired so much of the real estate in China's economy that you can learn about China and its economy from the stock itself. So let's go to the next slide. All right, first of all, China Internet facts and nuances. Next. All right, now there's some broad facts I want everybody to keep in mind about China. Number one, China's population is 4.2 times the US. We have 325 million, they have 1.4 billion. Okay, of that 1.4 billion, 800 million people have access to the internet, which is about 58%. United States, we have access on the internet about 92%. But the difference is almost all, let's go to the next slide. This is Huawei. Almost all of this is from the mobile base. For example, out of the 802 million subscribers I showed you on the last slide, 788% of internet users are using their mobile phones in China. So the mobile phone in the United States, of course, PCs, laptops, we have higher internet use. We also have more devices that are being used. In China, the model is the cell phone delivers everything, and anybody who has some space on the cell phone has 98% of the real estate. 98%. So just to give you an idea of what people do in China now with apps on their phones, 30% use bike sharing apps. Finding a bike like a Lime or some type of metro bike. 37% reserve bus or train seats online, and 40% books taxis. So China as a tech center is centered on these phones. So when you hear about Huawei in the news, you have to realize we are attacking the very core technology that drives all internet use in China. So let's go to the next slide. There it is. Look at that slide. That's amazing. All of it is mobile, 98%. Next slide. Okay, so Joe Tsai is the executive VP of Alibaba. He basically one of Jack Ma's big guys. So here's what he's telling you about the Chinese economy based on what he's learned running Alibaba. First of all, e-commerce gross merchandise value, which is the amount of stuff that's moving over their internet, 20 to 30% growth rate over the last 7 years. That's amazing, right? We hear the 6.5% GDP growth rate, but the shift to the digital economy is 3 to 4 times that, if not 5 times that. And the two big names you got to know about are Taobao and Tmall. Now, these are 700 million subscribers. Taobao and Tmall are effectively the 7th and 8th largest internet sites in the world. And so what it is Taobao is basically a form of eBay. It's consumer to consumer. Tmall is a business to consumer. It's more like an Amazon. And they have a third business called Alibaba.com, which is B2B, where you buy basically, a sourcing of shoes or shirts or whatever in China. You can log into Alibaba.com and find your source for anything you want if you're business to business. And they link it all together with what's called Alipay, which is basically PayPal. So B2B, B2C, C2C, and PayPal are all in the core business. So if you think about that as a macroeconomist, that is all of technology in China, right? And the size of the Chinese economy is 13 trillion, and they're creating $800 billion at 6.5% growth rate every year, of which 5 trillion of that, 35% of that, is the retail economy, all of which is driven by these mobile phones. So that's the model you got to think about when you think about China today. Next slide. All right, this is just telling you a little bit about the consumers and their thing. Let's go to the next slide. More stuff about what Joe Tsai thinks about you need to know about China. The second point is really a critical one for growth. Now, I told you before, remember, 1.4 billion people in China are there, man, women, children, everybody, old people. But 300 million of that number, about 25%, is middle class at this point in time. And the OECD says this will get to 850 million in 2030. So basically going to add 200 to 250 million per decade over the next 2 decades. So they can triple their business just by having income growth in their supplier base. So there's this incredible drive. The second point I think is fascinating is we always hear the bear case about the balance sheets and too much debt in China. And what Joe Tsai is telling you, it's all opposite about the Chinese household. You can remember the Chinese household that's getting this middle class growth is actually getting a healthy balance sheet. It has more available credit, and it will fuel consumption growth of the household. Now, here's a story you never hear about. You always hear about the state-owned enterprise and too much debt and the apartment overlay and all this stuff. Look what Joe Tsai is telling you. The healthy balance sheet of the Chinese household, right? That's all he knows about. The third one is this idea with the bike apps and the car apps, the digitizing of the retail sector. The total addressable market, because of that digitization, is the entire retail market of 5 trillion. So this is the story of what China is. It's a mobile-based digital market. It's likely to triple in consumption class over the next 20 years. And the balance sheets of consumers, because of that income growth, is very healthy. Let's go to the next slide. All right, I'm going to skip this one. Next one. Let's go back to the first one. Actually, let's go back. All right, this is the trade war. I forgot about his concern about the trade war. Now, what he will tell you, you read all the way to the bottom one. The Taobao and Tmall are the platform of choice for American companies and farmers to gain access to China. So what he thinks, and he's selling, is the idea that Alibaba is going to bring some of the demand for U.S. goods into China. He sees them as the solution for this, not the problem. Obviously, this sounds a little more salesy to me. I don't know if I really believe this to the degree he is, but he is right. When you own 90% of the mobile phone base and all the B2B, C2B2C, and B2B business, you have this charge. And by the way, there was a November meeting in Shanghai. We're back to this national championship idea. They were told to raise their collection of goods coming into the country, raise the sales from abroad. And now there's 40% of their sales on these online services are coming from abroad. So they are seen as one of the ways, and you get a call from the government in a country like this that tells you, hey, get the sales up from abroad here. Let's go to the next one. Next slide. Third, okay, regulation. Back to the next one, regulation. One thing to understand about Xi's China is he's not really concerned about the trade war. What he's concerned about is poverty reduction. It's a communist country that's worried about their poor. Getting that middle class up is getting poverty down. It's the same thing. So what you notice about what the government actually implemented with policies inside the country that you didn't hear about is they cut business taxes. They lowered the threshold for personal income taxes, giving lower income groups more to spend, and they created lower corporate income taxes for small enterprises. So they're focused on the poor and the small businesses and getting spending up on the lower income groups. That's actually where Xi's spending most of his time. He is not spending his time on this trade war. Next thing, next slide. Okay, Jack Ma. Now, Jack Ma is actually the founder, and he was at Davos while this Joe Tsai was doing this conference call. Now, Jack Ma is the real founder. He's talking about all this globalization for and all these mobile businesses because he was on stage at Davos with the president of Rwanda in Africa. And why was that? Because he thinks this mobile model is perfect for poorer countries. So the reason China has chosen the mobile model over the PC and the laptop model in the United States is they can get a lot cheaper phones into more hands and get more technology going in more places with cellular service than any other way, and they think they're going to move this as their great export business to places like Africa, India, over the next decade. They think this is the way to go, and he's pushing it at the WTO with this thing called the Electronic World Trade Platform, right, which is effectively Alibaba outside of China. EWTP. Next slide. Okay, so This is, I mean, it's amazing. Just remember, we're talking about a company that's 15 years old. It's 15 years old, and it's got 700 million subscribers. That's phenomenal. I mean, it's just, remember, the United States has 325 million people. Just one single company, one corporate structure has twice the number of consumers than the entirety of the United States population. It's phenomenal. So let's go to the next slide. All right, so we've already done this. Those are the core businesses: Taobao, Tmall, Alibaba.com, and Alipay. Next one. This is just more stuff I want you later to look at. The main point I want to picture out of that bolded is the Alipay was up 27% year on year. And the Singles Day back in November, which was done over Alipay, was also about 27 to 28% year on year. So again, if you're hearing about the slowdown in the Chinese economy because of the trade war, tell me about 27% year-on-year growth rates, and that's telling me it's phenomenal. Phenomenal, right? Next slide. All right, this is the other things to know about. New retail and local consumer services. The other thing that they're doing now that they put the mobile business in play is they're redefining the brick and mortar stores in China. We can get into what all these things is: Freshippo, which is a grocery store, the Taobao app, and service delivery. But basically what they've done is they've come up with a way to get all kinds of local delivery to your house for any consumer or merchant in their entire economy. And so they're giving another boost to the economy, which is all these new retail and local services to deliver basically food. Like, you know, we can think of it as a Domino's pizza kind of situation, or a Amazon food truck. These types of things, this is their other growth rate, and it's baked into their core business. Next one. Okay, let's skip this one. Cloud computing. So they have two other businesses in Alibaba outside the core. One is cloud computing, which is growing about 80% a year, but not profitable. The other is an entertainment group, which has got Alibaba Pictures, which is growing about 20% a year, and probably not profitable and may never be profitable. But cloud computing clearly is something that they can drive a lot of business because it works with their core platform, and they're getting a ton of traction, just like Microsoft and Amazon, with this cloud computing. And this goes to show you why people use national champions, because clearly Amazon and Microsoft would break in China and take over this 80% growth rate business if Alibaba wasn't there to do it themselves. So this is what happens: is they continue to ask these champions, national champions, to go into new businesses. So the good news is the cloud computing business is on solid footing and is growing. Go to the next slide. But the Netflix idea is struggling over there. Yeah, they've got some growth rates I can throw up here that are pretty strong, but the other thing that can happen here with Alibaba, when you have a national champion who's basically an oligopoly earning monopoly profits, is that you can throw away some of the money. So some of the reason the returns on this stock have not been as strong as people thought is because basically they're throwing money away at stuff like this. Anybody in Los Angeles will tell you that one of the easy ways to lose money is to make films if you don't know what you're doing, and that's what they're doing. So don't give Alibaba credit for doing everything right. They'll stick with this for a while because, again, I think they want this group to be a Netflix along with an eBay. They want Alibaba to be everything. So they're going to stick with it, lose some money. But again, this is part of this model China's putting up with. Is that, by the way, nothing to do with trade wars. It just have to do with their way of building a business that's strong, is domiciled in China. Next slide. All right, quarterly earnings. Let's go. Next slide. Next slide. All right, so they beat. They beat pretty handily. $1.84 EPS. Next slide. And Reuters wrote it up and said, oh, gee, they did terrible, right? All the investor worries and mounting pressures and all these things. Now, that's Reuters in London. And so does anybody pick up in the previous slides I sent to you all the negative news? The answer is no, you didn't, right? Because there was none, other than out of Alibaba Pictures, which is not relevant for this discussion at a macro level. So the bottom line is there's a huge gulf between what is written about China and how many problems it seems people think it has, versus the reality that places like Alibaba are doing fine. It said, yeah, quarterly revenue grew at the weakest pace since 2016, but that pace, 27% a year. That's incredible, you know? I mean, it's just amazing, right? Next slide. There it is, right? Look at all those growth rates. Just look at the top. Those are the growth rates, right? That's this latest quarter a week ago. The country is not rolling over. It's not in trouble. This is the core tech business, consumer business of China at the moment. Next slide. There it is, cash flow. If you don't like the top line, let's talk about the money they're banking. And they're banking between 17 and 11%. They've also announced a share repurchase. They're a quarter way through it. Just like everybody else, their end of share repurchasing is driving other forms of income. You got to like this. You got to say, hey, you know, this is an economy, again, benchmarking the economy is 6.5% growth. They're doing double that in an annualized, very adjusted cash flow and triple that if you don't adjust it. So they're doing fine. Next slide. There it is. Next slide. And by the way, 100,000 employees now. Next slide. All right, short-term perspective analysis. They chased earnings estimates down, these analysts. Let's go to the next slide. And they chased it down with the share price. Next slide. Here it is. I think this tells a lot about the stock market today. I looked this morning, my own Micron, which is a Zacks number 5 ranked stock. It's up 6.5% this year. And Alibaba is no different. Look at this story. I just told you about all this good news, all this stability, 27% growth rates, 12% earnings growth rates, cash flow. And look at this story of what estimates are for Alibaba. They went way up. All of a sudden, at 27 range, rolled the stock up to $200. Then they stopped at around $8 or $9 a share. Remember, they did 185 last quarter. That's basically saying that's as far as they're going to grow right now. And then suddenly, they just took all the way down to $1.50 a share, basically, entering 2019. And now the stock lost $40 a share. You can look at a chip stock. They're all like this. We all know the story is, well, it's the China trade war, right? So what happens here is we've gotten a real disconnect between the reality of these companies, which is actually fine, and the analysts who are basically chasing the stock price up and down with their earnings. I think what I've learned in these markets where price targets play such a big role, people are moving estimates up and down to basically make their price target not be so far out of line. But the truth is, if you want to make some money here, I don't know where the bottom is in Alibaba, and that's the problem with the Zacks ranking system at these bottoms. It doesn't do a very good job because we don't get the core analysts among the 30 analysts that follow Alibaba. 5 are probably very bullish and very right, but they're buried in all these other cautious people that have been burned last year. They're not going to raise their estimates up. So sooner or later, there's a big play here. Chip stocks and Baba and other Tencent, and YY, JD, all these kinds of companies. Some point, it's going to turn around with this China trade war. And this is exhibit A of we have 3 regimes. Way too bullish, and not bullish at all, and then way too bearish. And it's only been over a year and a half. That's crazy. Let's go on the next slide. All right, so my 3 points. There it is. Watch the herd, right? This was all about herding behavior and analyst positions over the last year, basically. Next slide. Next slide. All right. Stock market beta on Baba is 2.2. That's the other thing we need to talk about in terms of stocks, which is what this call is really about. Chip stocks and Baba and things like it have huge high beta. So if you're shorting markets, this is what you love to see. Because you can make twice the market return by shorting a stock that's going down. However, when it goes up, you make twice the market return. So once markets turned around in January, stocks like Baba and the chip stocks are going to double their return. So if you worry about algos and trend following in January or in November and December, you should do the same now and ride these guys up with these high beta names. So the point here is the high betas, the betas themselves on stocks, when there's trend following machines alive, really becomes something you need to focus on, and you need to realize what the beta is of stocks you play. And betas of 2.2 tell you that this stock, if there's a bull market, this stock's going to double returns for people who own it. Next one. Right, there it is. BABA, 14.4, S&P 7.6. There's your classic beta, right? Classic 2x beta. Next one. All right, so my actual conclusion. Let's go on. All right, here again. Remember the analyst slide? Here is the earnings history. Notice the big dip, the big elephant, the big hump? No, you don't. There isn't one, right? There isn't one, folks. There is no problem. Yes, it did slow down, but that's really them hiding the earnings off to those other core business and cloud and pictures. It's not them, because go to the next slide, and there your sales growth. Look at that sales growth. Now, remember the analyst projections. What are they talking about? Seriously, what are they talking about? I don't see any change in this whatsoever. Someone's wrong, and someone's just worried about their job, and they're the analysts, and they're basically worried about staying too far out of a herd more than they're interested in paying attention to fundamentals. And so I'm going to close this up and wrap this up for Shiraz. My points today are, let's go to the next slide. You basically, go to the next one. You basically have a story of a market that's been completely stunned and killing off stocks on Alibaba, which is the U.S.-China trade war. None of us, we all know this, right? But so I want to finish before I hand out to Shiraz my 3 probabilities on the trade war, because the trade war drives the stock market right now. It's the uncertainty that lifts, stocks go up, or even if there's even a halfway good deal, stocks go up. So let's take a look at that March 1st deadline and the probabilities. U.S.-China trade deal on March the 1st. Mnuchin this morning on CNBC said he's off to China next week. They're going to close a trade deal by March the 1st. What do I think that's going to happen? I give it a 25% probability. Why is it so low? Because there's too many intractable issues in the intellectual property space. I just showed you the growth in BABA. There's no way they're going to disrupt that growth by screwing up anything, and they could care less. So 25% probability of deal on March the 1st. However, I have a 50% probability of a deal sometime this summer in a quarter or two. I think they can basically save face here, and the administration, the U.S. and China, can get a deal done sometime this summer, but it's not going to be a very good deal. There's not going to be a lot of give back here. It's just going to be more of a cosmetic idea that the U.S. and China make a deal sometime this summer. Now, the third idea that you have 25% probability is the administration gets tough after the failure of the March 1st deadline, moves tariffs to 25%. I don't think that's a very high or likely idea, but there are hawks in the administration, and they can push this forward. So, bottom line is watch the chip stocks and stocks like BABA, and then like they're rising today. What that tells you is that people are back channeling the idea there'll be some kind of trade deal, right? And sometime a deal, any kind of deal, is better than no deal. Now, on the limit, the presidency is 2 years from being over. Whether it gets renewed or not is an issue for the voters. But for us as watchers of stocks, what we know is they very much like a deal before they go to the voters. And that's the other thing, is the Chinese can soft pedal this thing and wait to see what happens in 2 years. Give us some kind of halfway deal this summer and see what we want to do. But basically, those are my probabilities. And so my point is, don't get too in front of this trade. There's probably going to be some pessimism and some misperceptions on what's going to get done. But I do think a deal will get done this summer. And basically, these all get updated as time goes on with more news that comes in. But try to work out these 3 scenarios in your stock portfolios and kind of think it through a little better by putting these probabilities down on paper and realizing that basically a lot of times here with uncertainty driving markets, high betas and stocks that are going to grow out of trade wars, those are the areas where you can find some winning trades for your clients. And with that, I'll hand it over to Shiraz.
John, I'm going to jump in here before we get to Shiraz. But Shiraz, that does bring us to you. Thanks, by the way, John. So, Shiraz, the outlook for China, while we're on that topic, seems to have appeared as a recurring topic in a number of earnings calls recently. What do you make of that?
Yeah, so one takeaway that our listeners could take from John's very detailed presentation is that even though there are some uncertainties and some question about China as a whole, and then segments of that very fast-growing economy. If you have a longer-term outlook, things should work out. I believe the probabilities he's talking about in terms of the trade deal also make sense. But the one area where I will push back a little bit comes down to the point you're raising, Terry, and that's this China becoming a recurring theme with all these companies. When the earnings season got underway, and we got that Apple pre-announcement, I was in the camp to pin that on Apple-specific issues, and I thought earlier in the reporting cycle in December we had Nike results, and Nike had very good China numbers. After the Apple pre-announcement, we had Starbucks numbers. Starbucks had good China numbers as well. But as you rightly point out, it became a recurring theme. And it goes on to this, one of the three main worries, aggregate macro worries in the market about global growth and growth on the margin in China. So overall growth is still very good. As John pointed out, he mentioned $800 billion annual output created, but on the margin, it's trending down, and that has an impact on the likes of Apple, or this morning we had GM. So global growth is uncertain. The outlook for China is uncertain. The outlook for the U.S. economy is very good, and that is the big aggregate macro question mark over the earnings outlook as a whole. That's how I see it, Terry.
All right, and let's bring it down to the Q4 season now, and so we'll get a little bit more specific. With everything that we've seen this Q4 earnings season, namely lower earnings growth, positive surprises being harder to come by, you and I have talked about this, mixed corporate guidance, you say, overall, the season is better than originally feared. And is that because analyst expectations had been dialed back just before the season began?
Yeah, even more than that, Terry. Estimates did come down as they typically do, though estimates for Q4 had come down more than what we had seen in the six immediately preceding quarters. In total, about a third of Q4 growth was shaved off. But I think there was an even a feared and whispered expectation that perhaps the cuts, the estimate cuts, had not gone far enough, and it is relative to those feared bad numbers that results have turned out to be not as bad. And we saw that with financials. We have seen that with a number of the other industries as well. But estimates and the cuts that estimates suffered for Q4, and I'll show us in some of the slides how the outlook for the coming quarters is shaping up. But if they had been cut more than should have been the case, then we would have seen in higher proportion of positive surprises this earnings season, which is not the case, as I'll show in my slide. So
take us through the numbers. No, take us through the numbers.
Let's go to the numbers. So let me give you the scorecard. If you bring my first slide, and this gives the current scorecard. So as of this morning, we have 282 S&P 500 companies have reported results. The first column in this busy-looking table shows you the proportion of each sector, and then for the index as a whole, how much they have reported. As you could see, for the conglomerates, the earnings season is over. For a number of other sectors, particularly transportation, in aerospace, in industrial products, we have substantial portions of these reports already in. The third from the bottom row is the aggregate picture for the index as a whole. So for these 282 index members that have reported results, including the results that came out this morning, total earnings are up 12.9%. Total revenues are up 7%. 66.7% are beating EPS estimates, and 62.8% are beating revenue estimates. I just want to make two quick points of explanation before we move on to the next slide. The first one is that the version of earnings we are discussing here is what we call as EPS BNRI, or earnings before non-recurring items, which expenses employee stock options. The result of that is that Zacks earnings estimates, both estimates and totals, would be a bit smaller than what you would see from other data vendors. And then the second point I want to point out is that these growth rates are not EPS growth rates. These are net income growth rates. So we do that to make sure that the accelerated pace of buybacks are not giving us an artificial growth rate. So if we move to the next slide, this puts the scorecard numbers we got in the preceding slide into a historical context. So what we are doing here is, by the way, the green columns represent earnings, the orange ones revenues. So the left-hand chart is comparing the earnings and revenue growth rates in Q4 18 for these 282 index members to what we had seen from that same sample of companies in these other recent periods. So the left-hand chart, you could clearly see what Terry was referring to at the top of the segment of the growth decelerating. You could see earnings growth is about half what we saw for these companies in Q3 or the 4-quarter average. Revenue growth similarly is less than what we had seen in the recent past. The right-hand side part of this chart is showing you the proportion of these 282 companies that are beating the Zacks consensus estimates. So 66.7% are beating EPS estimates, and 62.8% are beating revenue estimates. And as you could see, that the proportion of these Q4 companies beating estimates is notably on the weaker side. And the weakness is particularly notable on the EPS beats. So if you go to the next slide, where I spotlight this weak tendency. So here we're just isolating this weak positive surprise ratio. So you see for Q4 18, the EPS beats are particularly on the weak side. The 66.7% for these 282 companies is significantly below what we had seen for the same group of companies in Q3, in Q2, in fact, all the way to the 12-quarter average. In my model, I maintain data for 12 quarters, and in that 12-quarter period, the proportion of positive EPS surprises is the lowest in my data. So this goes back to the point that Terry was raising with respect to estimates for Q4 having been come down ahead of the start of the earnings season. This would indicate, this low proportion of positive surprises would indicate that perhaps estimates needed to come down even more. And the one takeaway from this would be that perhaps as we went to the end of the quarter, these companies experienced some weakness at the margin that they had not initially expected. And that's perhaps accounts for this unusually low proportion of positive EPS and revenue beats. If we go to the next slide, this shows the blended picture for Q4, meaning we have taken the actual earnings for the 282 index members that have reported with estimates for the still to come S&P 500 members. And as in the scorecard table that I shared earlier, the third row from the bottom is giving you the aggregate picture. So total earnings for the S&P 500 are expected to be up 13.3%, which compares to 25.7% in the preceding quarter. Revenues are expected to be up 6.1%, which compares to 8.5%. So in Q4 18, margins are on track to be up 80 basis points, which compares to 170 basis points in the preceding quarter. So if you go to the next slide, this gives you a big picture view of where we are. The blended 4Q18, the 13.3% earnings growth and 6.1% revenue growth is right in the middle. It shows the 4 quarters preceding this period, and it shows the 4 quarters after that. And as they say, a picture is worth 1,000 words. You could totally see here as to the extent of deceleration we are seeing in earnings. The 1Q19, the current period, earnings growth now is -2%. And as you can see on this chart, 2Q19 is barely in positive territory now. Another notable thing to keep in mind here is that the revenue picture is a lot stronger. The revenue growth pace is also decelerating relative to what we saw in 2018, but not to the same extent as we are seeing with estimates for earnings. Part of that, the deceleration in earnings, is the pure arithmetic of the benefit we got from the tax cuts in 2018, which is obviously no longer there. And another part of that is these global growth worries. China, we mentioned. There's questions about Europe. Some folks have concerns about the U.S. outlook too, and all of that is showing up in estimates for the coming quarters. If we go to the next slide, you will see now we are stepping back from the quarterly presentation of data to the annual. And as you could see, 2018 is totally off the charts, very strong growth. 2019 is significantly below that level, and the expectation is for fairly strong growth in 2020. So if we go to the next slide, and here is what we have been discussing earlier in the context of Q4 earnings season. This is how estimates for the current period, 2019 Q1, and also for full year 2019 have been shaping up in the recent past. So as you can see, the left-hand side chart, which shows the revisions trend for Q1 19, we started off at close to 5%, and now we are in negative territory. If you look at the right-hand side chart, which is tracking the revisions trend for full year 2019, at the beginning of the second half of 2018, the growth expected was for close to 10%, which remained fairly stable for the first few months, but then started coming down in a notable way and is now almost half of what was expected. So that concludes my my discussion and analysis of the earnings picture. The key takeaway from what we have seen in the results thus far, and also of what is expected on the revisions front, is that there are legitimate worries about global growth, which ties into the trade issue as well. And that is adding to uncertainty, and that is prompting the analysts to cut their estimates, and we are seeing that in the aggregate data.
So Shiraz,
that concludes my discussion.
Shiraz, you and I have talked about this one point. I just want to make one clarification here. Is the level of earnings growth or lack thereof that we're seeing here more of a return to normalcy? Is that how you could characterize it versus what we've been seeing?
I think that's a fair comment. Keep in mind, Terry, that the earnings cycle, this earnings cycle got underway when we came out of the last recession back in 2009. So it has been a very long period through which we have had some really impressive gains on the top line and margins, and as a result in the bottom line. If we had not had the massive tax benefit in 2018, I think a mid-single to high single growth pace would be a very strong growth pace for the index as a whole. If we come down to anywhere from 5% to 7% earnings growth, that should be reasonable for the S&P 500. And your comment about the growth coming down to a normal level, I think that's a fair comment, and that's a true representation of reality.
Okay. Unfortunately, and I say this every time we get together, that is all we have time for today. Thanks to our panelists, John Blank and Shiraz Mian, and there was certainly an information-packed session here. We hope you found it that way and interesting as well. So if you have any questions regarding our services, feel free to email them to zrs@zacks.com. If you would like copies of John's or Shiraz's PowerPoint presentations featured in today's call, again, the email address is zrs@zacks.com. You can also contact your ZRS representative directly, or you can access those PowerPoints in the GoToWebinar Council. In the meantime, thanks again for joining us. Feedback always welcome. And after you close out this webinar session, in fact, you'll be prompted to fill out a 1-minute survey. We'd appreciate if you would take the time to do that so that we can use your comments to improve the quality and the content for future calls and give you more closely what it is you're looking for. And as always, again, we look forward to the next time we're all here together on the call.